Now, let's discuss about the three types of signals that the MACD indicator provides. First, the MACD crossovers. Crossover buying and selling signals are the most used type of signals traders use with the MACD. It happens when the two lines cross. It displays the moment where the momentum accelerates. There are two types of crossovers, bullish and bearish. Bullish MACD crossovers occur when the MACD line crosses above the signal line. See the green circles in the chart above. This signals that the price of the underlying asset is likely to increase. Bearish MACD crossovers occurs when the MACD line crosses below the signal line. See the red circles. This signals that the price of the underlying asset is likely to decrease. Second signal is MACD divergences. Another type of signal used with the MACD is called divergence. A divergence happens when prices are moving in one direction, but the indicator is moving in another one. Bullish MACD divergences happens when the prices form lower bottoms, but the MACD forms higher bottoms. This signals that the price of the underlying asset is likely to reverse and increase. Bearish MACD divergences happens when a price forms higher tops, while the MACD forms decreasing tops. This signals that the price of the underlying asset is likely to reverse and decrease. In this example, we can see how important it is to use the MACD with technical analysis to validate signals. Basic technical analysis techniques such as supports, resistances, trend lines, and channels are easy ways to confirm trading signals. Let's have a look at the second divergence. The EUR-USD is going upward, forming new highs. However, MACD tops are lower. This bearish MACD divergence is confirmed by the price reversal. The currency pair trades above the major resistance for only 3 days. After that, it went back down, which also corresponds to a bearish MACD crossover. Let's zoom in. If you're used to trading with candlesticks, you can easily recognize the reversal pattern in the red circle. It's a shooting star. This is a bearish reversal pattern that indicates that the bullish pressure is losing momentum. The buyer drove prices higher, but the sellers took control during the day and pushed prices down. The selling pressure was so strong that prices ended up the day at their lowest level. This is an indication that traders should be cautious. The next candle is a bearish spinning top. The following candle is still bearish as it has a long red candle with almost no shadow, a bearish Marubozu. A Marubozu is usually an indication of a strong buying or selling signal. In our example, as the body is red, it's a strong bearish signal, especially as it happens on a major resistance level. As you can see, candlestick analysis combined with technical analysis will help you confirm trading signals coming from the MACD. The third signal we would like to discuss about is the overbought, oversold MACD. It's not a widely used feature of the MACD, but it can also give an indication on whether an asset is overbought or oversold. The MACD doesn't have a dedicated area where it spots both situations. You can, however, see it by looking at the distance between the two main lines of the indicator. To spot overbought or oversold situations, traders should be looking for important rises or falls in prices that do not match the trend. If prices increase or decrease too quickly, there is only a small likelihood that they can keep the pace and remain at those levels. Therefore, they are more likely to reverse. By looking at the MACD, you can spot these moments where the shorter moving average is diverging from the longer one. This is actually telling traders that prices of the asset have moved too far away from the historical averages. Thus, there is a high chance that prices will be forced to go back to normal trading prices. That's it for now. On our website, you can find more posts and podcasts. I hope you enjoyed it, and don't forget to subscribe to our podcast channel on YouTube. Do you use MACD indicators in your trading? If yes, are they the only tools you use, or do you use them in combination with other indicators? We would love to know your thoughts, so feel free to share them in the comments below.